In 1994, the smartest hedge fund in history opened its doors. Long-term capital management. Its partners included two future Nobel Prize winners, the men who had helped write the equation that Wall Street uses to price its options. For 4 years, they looked unbeatable. $1 billion soon became 4.5 with barely a down month. But in August 1998, long-term capital management lost essentially all of it in a matter of weeks. Their mistake? Blind faith in their Nobel Prize winning model. Leverage made that mistake fatal. For every dollar the fund actually had, it had borrowed 30 more. Then, Russia defaulted. Bets that were never supposed to move together all fell at once. And when the fund tried to sell, there was nobody buying. According to their own calculations, a loss of that size should not have happened even once had the fund been trading every single day since the beginning of the universe. And not just one universe, billions of them, run back to back. So either LTCM was the unluckiest fund that had ever existed, or their model was measuring the wrong universe. In the previous 2 videos I showed how a formula made gambler Bill Benter a billionaire. John Kelly told him exactly how much to stake and it worked, but for one reason we quietly skipped past. You see, at the racetrack, the odds are printed on the board, and in a casino it's even cleaner. A European roulette wheel has 37 pockets, not roughly 37, exactly 37, every single spin. So you can therefore compute the house edge to as many decimal places as you like, 2.7%, and it will be 2.7% in a year's time. Casinos are one of the very few places on Earth where uncertainty is neatly packaged. The odds are fixed, the rules don't change, and risk behaves exactly as the textbooks promise. The problem is that we carry this intuition into the real world. Nassim Taleb called it the ludic fallacy, the mistake of believing that life resembles a game with known odds and stable rules. But markets don't work that way. Nobody tells you the true probability of a crash, and while you're trying to estimate it, the wheel itself is quietly changing shape. So what does finance use instead of printed odds? It uses a map. For more than a century, that map has looked like this. Drop enough balls through enough pegs, and they pile into a familiar shape, the bell curve. It's one of the most beautiful ideas in mathematics, and for many things, one of the most accurate. Heights, measurement errors, coin flips. But a map is only useful if it describes the territory. The bell curve makes one simple promise: extreme events are rare. Really extreme events are astonishingly rare. Statisticians measure that surprise in units called sigma. Think of sigma as the bell curve's ruler for measuring the unexpected. 1 sigma, very ordinary. 3 sigma, memorable. 6 sigma, roughly a once in a million years event. 10 sigma, that's the model's polite way of saying this isn't going to happen. So let's see whether that promise survives contact with reality. Here are every daily return of the S&P 500 since 1950, stacked into a histogram. Now, lay the best fitting bell curve over the top, and at first glance it looks convincing until you actually compare them. Reality breaks the promise in 2 completely different ways at once. Let's start in the middle. You see that tower? Markets do almost nothing far more often than the bell predicts. They're quieter than the model expects, until they aren't, because out at the edges sits days that the bell insists should barely exist. October the 19th, 1987. The market fell more than 20% in a single day. Measured against ordinary daily volatility, that's roughly a 20 sigma event. The odds of such an event were less than 1 in 10 to the power 50, a number so absurd that the universe itself isn't old enough to expect it even once. And yet, it happened. Somehow impossible keeps turning up every decade, and when your map insists that the mountain cannot exist but you keep crashing into it, eventually you stop blaming the mountain. So why does the bell curve work so beautifully for some things and fail so spectacularly here? Well, because randomness comes in 2 very different flavours. Take height. Human height follows the bell curve almost perfectly. Measure 1,000 people and you'll get exactly the shape the textbooks predict. Now, invite a handful of the tallest people on Earth into the room. Basketball players, 7-footers. Every one of them is an outlier. Watch what happens to the average. Almost nothing. It moves by a few millimeters. You see, human height lives in a world with ceilings. Biology simply refuses to manufacture 12-foot humans. Under this kind of randomness, no single observation is powerful enough to dominate the rest. Now measure wealth instead. The average person in the room is worth, say, $75,000. One single billionaire walks through the door, and suddenly everyone is now a millionaire, on average. One observation didn't just change the story, one observation became the story. Plot that room and you don't get a bell curve, you get a cliff of almost everyone, and then a tail stretching out to that one billionaire standing completely alone. Heights live in the first world and markets live in the second, yet many of finance's favourite risk models quietly assume we're much closer to the first than the second. One of the first people to notice this wasn't an economist, it was a mathematician, Benoit Mandelbrot. In 1963, he studied 90 years of cotton prices and noticed something everyone else had quietly ignored. Under the assumptions of the bell curve, that century should have produced just 3 months beyond a 3 sigma move. Cotton delivered 19. Those violent months weren't noise sprinkled around the real story, they were the story. Remove just the 10 biggest months from that entire century and the outcome changes completely. Which brings us back to Kelly. Kelly only asked for 2 numbers, your edge and your risk. At the racetrack, both were printed in front of you. In financial markets, neither really is. Your edge is an estimate, we admitted that 2 videos ago. But it's worse than that. The denominator is an estimate too. The decade of data you used to estimate market risk may simply have missed the one day that defines the next decade. There is one final line of defence, and it has its own blind spot. Analysts take every return the market has ever produced, throw them into the air, deal thousands of new sequences, and ask whether the strategy survives every one of them. It feels exhaustive. But the shuffle never invents a new card. It only rearranges the ones history happened to show us. So here's the rule that the survivors follow. Assume your inputs flatter you, bet less than the formula suggests, and leave room for the day your spreadsheet insists cannot exist. If this changed the way you think about risk, subscribe, because the next question is the one every formula eventually has to answer. How do you survive?